Hi, everyone. I'm Brien Lundin, and I am bringing you our industry panel, industry panel for our New Orleans conference attendees. We have the great pleasure here of welcoming Gwen Preston, the resource maven who we'll get to in a minute is actually expanding her publishing empire. And we'll talk a bit about that. We have David Wolfin of Avino Silver and Gold Mines. We have Peter Gianulis of Allegiant Gold. And we have Rick Trotman of Barksdale Resources. All three companies, and in particular, all three gentlemen, bring some very valuable perspectives to the metals and mining markets and their state today and going forward. Kind of the general thing we want to talk about today is what's going to happen in 2021. Obviously, 2020 was a very interesting year for the metals and mining markets. Of course, interesting across the board in every way and manner possible. But 2021 has already started off as with quite a bang, and we're going to try and get some perspective on where we may be heading, how investors can take advantage of these big trends we see underpinning this market, and some of the volatile short-term issues that are popping up along the way. I'd like to start off with you, Gwen. First off, my goodness, you're becoming a publishing maven as well as a resource maven, right? New newsletters, renaming newsletters. Before I ask you your opinions on the markets, what's the state of your enterprises right now?
Oh, well, thank you for asking. Really, as you are very familiar, there's so many things to talk about. When this market has some wind in its wings, there's so many things to talk about that one person can't possibly, there aren't enough hours in the day to communicate about all the things that deserve attention and all the companies in those various categories that deserve attention. So I had long been interested in starting one or two other newsletters to try and address some of those areas, but I just didn't have the bandwidth on my own. And it's very tough to find someone who can join, right? Can join and have the similar foundation as me, ability to communicate, and the attributes that you need to do the job that we do. But I found someone in Peter Kraut, and he had written a newsletter of similar sort for a bigger publishing house back in the last bull market. He's fairly well known from publishing articles on the state of the metals sector across a bunch of different websites, Kitco, Streetwise, all those sorts of places. And so we've joined forces. So he took over my monthly newsletter that is for generalist investors, and he launched a silver newsletter on January 1st. And interestingly, there isn't really another newsletter in the space that is just about silver.
Mhm.
So that seemed like an obvious opportunity. So busy days, but I think it fits with the macro situation. It's a time that deserves busy days.
Well, Gwen, when you started your newsletter, it was the bottom of the market, and I commented to you over and over ad nauseum about how fortunate you were to start at the bottom of the market because your track record was going to be so spectacular, and so it was. Now, starting a silver newsletter as the silver squeeze emerges is another example of your extraordinary gift of timing. Quite remarkable. So given your clairvoyance, your obvious clairvoyance, what's your views right now on the metals? I mean, we have these fundamental, I know you and I agree a lot on the mega trends, the monetary mega trends driving the metals and therefore the mining stocks. And sure, we started off great with two powerful days of trading right out the gate in 2021. And then the bottom kind of dropped out. And then we had the silver squeeze. It sure has not been boring, has it? And what's your view? Does it, this first few weeks of trading, does that invalidate anything? Or are there any areas that investors need to especially look out now that have emerged, look out for?
Well, I could take up 45 minutes on my own just answering that one question. So I will try my best not to do that. I
Okay.
think that the beginning of the year was fraught for lots of reasons, especially across America. And so I think there was a lot of forces that pushed the metals markets around, that pushed all the markets around, and fair enough. So in general, I try not to worry about the day-to-day stuff. I think you have to step back and look at the fundamentals. What do the macroeconomics tell us is coming down the pipe? Try not to worry about the day-to-day unless you're a day trader, which I'm not. And in that setup, I really do think that we are looking ahead at broad commodities strength. which is a super fun thing to say because, 18 months ago, that's not what we were really looking at. There was all kind, just sort of a plow horse economy and not a huge amount of reason to think that there was a broad commodities bull market coming. But now that's where we are. What do we need for a broad commodities bull market? We need strong demand for metals against insufficient supply. We have that across most metals now. I mean, you can look at copper lately and all of the expectations of a ramp up in demand for copper, which are very real. That makes a lot of sense against, very limited CapEx spending and insufficient supply coming online. So I think, the setup for copper works. You can say the same for a lot of sort of energy metals, right? Silver, I think, is set up very well in that sense. Nickel is as well. So you need strong demand against weak supply. We have that. Ideally, you want a not strong US dollar. I think there's lots of reasons to believe that that is the case, that the US dollar will not be a headwind for commodities. So that helps. For gold, you want negative real rates. Well, we are well in that territory and we ain't getting out of it anytime soon for a myriad reasons. So that is propelling the gold story. And then I think you need investors to have reason to be interested in commodities, right? And we've had this crazy bull market that's been going on and continues to go on in the general stocks right now. And that's fine. But there certainly are increasing flags of risk. Now, you called me clairvoyant, which is completely false. I have no idea what is going to happen.
I'll call you modest at least, and that we won't argue about that.
Thank you. But I mean, I think there's a lot of reason and a lot of agreement that there's risk out there. And I mean, if you want to look at GameStop and these sorts of things, the volatility that adds, that's just one example of the fact that there's a lot of speculation and that there's a lot of top type activity happening. The market can continue in this state for quite a while, but whenever you're in a state where these sorts of risks are very real, then the need to diversify stands out. And so when you look at the commodities, they stand out as a diversification option. So you can think of that as gold itself as a safe haven, but you can also think of it as, copper miners printing money and silver miners offering incredible yields. And so commodities step into that gap. And it's a really interesting space. It's a huge discussion. People used to buy big safe money, used to buy bonds for yield. That game doesn't exist anymore. Now you got to buy bonds for price and own stocks because there's no such thing as yield. So the idea of what you buy for safety and diversification has shifted completely in the last 15 years. And now commodities are one of the things in the current climate that can really step into that gap. So I think all four forces there really step up and set us up for a commodities bull market. And, day-to-day gyrations aside, I'm pretty optimistic about 2021.
Yeah, I completely agree with you as usual, Gwen, and you say it so well. But as newsletter writers, we keep telling our readers, focus on the long term, focus on these big, powerful fundamentals because, hey, they're in our favor now for a change, and we have a multi-year bull market ahead. So don't worry about the day-to-day fluctuations. And by the way, here are the day-to-day fluctuations and why they happened. And we have this requirement to offer up some kind of a commentary on the day-to-day fluctuations. And of course, it's hard emotionally not to worry about that. David, I'd like to bring you into this discussion because God, man, you had some day-to-day fluctuations this week of known as the original silver play in the junior mining space. You were really, I bet you popped open a bottle of champagne on Monday, and I don't even want to know what you did on Tuesday. As we speak, we had the big silver squeeze on Monday. Silver soared, looked like it was going over $30 in a flash. And then the powers that be handed the bag unceremoniously to all the retail investors on Tuesday and told them who was boss. And we reversed all of those gains and back again. So Avino, I think, if I remember correctly, kept some of the gains that it got from Monday, but
absolutely.
It's already a very interesting story. You were raised in the mining sector. Avino had some challenges this past year that you put behind you, and you're already getting ready to ramp up production. As a company that can immediately profit from rising metals prices, and has a rising production profile. What was it like on Monday and Tuesday? And what kind of inquiries have you been fielding as this whole silver frenzy kind of erupted?
Oh, well, it started probably at 4 a.m. Pacific. My phone was going crazy. So hundreds of emails and calls. We traded 129 million shares on the New York Stock Exchange on Monday and 9 million shares on Toronto. We were the number one trader on Toronto and number two on the NYSE American. Yeah, so it's been fantastic.
How many shares are out?
89 million.
He's trading 1.5 times your whole float.
Yeah, they issued.
Your
Yeah,
whole float, your whole issuance. My
Yeah.
goodness.
Yeah.
That is crazy. It's a good thing you kept some shareholders from that. But what are your views then on the silver market? I know you watch it like a hawk, and you have actually some offtake agreements and the like. Are you getting any feedback from the bigger players in the market?
Oh yeah. Well, the commodity traders, Trafigura and the off takers are all calling us. They want product. We have a long-term agreement with Samsung, so they use it in their products. And so, yeah, demand is growing. It's what everyone was expecting in the last few years. So I expect it to maintain this level, if not go higher.
Yeah, the entire, and I was fortunate to seem clairvoyant by earlier in the week last week predicting that at some point this year, all the available bullion supply would be absorbed. And it wasn't a real bold prediction because that's already happened a few times over the last decade, but that it wouldn't take much for that to happen. And sure enough, instead of happening at some point over the year, it happened over the weekend.
Yeah.
There are other.
The SLV had huge inflow.
Yeah,
last
and who
week.
knows where they got
They
that.
they brought in 110 million ounces, like $3 billion worth.
Yeah, yeah, and apparently there's not that much, or that was, I believe, 10% of all of the silver in London, and that silver is sourced for SLV from J.P. Morgan, who says, "Don't worry, we sent the silver over to them." So there's a big question there.
Yeah.
Trust the group, the custodian that just paid a $900 million fine for spoofing the markets.
Yeah.
To actually deliver the silver. So is there a shortage of silver is what I'm getting at. Is there a shortage of big bar silver that goes into these ETFs, that goes into these trusts? Because there sure as can be is a shortage of retail bars and coins.
I believe so. Yeah. I mean, but there was a cloud over the market because of the paper silver. But now that the Reddit army is out there, forcing the covering in these companies and the buying of silver, it's changing everything. So this is fantastic what's happening, and I expect a more transparent market coming in the future.
Yeah, I hope so. My view is that they need to buy physical silver and force to that arbitrage between force there to be an arbitrage between the paper silver market and the physical market, which is already at about a $3 to $4 premium in the physical market over the spot market, the paper spot market. Peter, I'd like to get your views on this as someone who ran a fund in the junior mining sector. If you were out there looking at plays right now, value plays, I know the primary value play you would probably talk about or invest in would be Allegiant, because you've got over 1 million ounces of gold resource in Nevada trading at around $23 million market cap. So you would be buying it. And I know you actually are buying your company's stock in the open market. What is your view right now on, given the start to this year, given the macro trends, where should retail investors look to right now? Is it the junior producers, optionality plays, the exploration plays, the companies that have resources like you have? Where should they look?
I think there's room for everything in the whole sector, whether that's a junior producer, all the way to the exploration, which in my 25 years, I don't recall it being this cheap, possibly when Briex blew up and the aftermath of that in the beginning of the 2000s. But I don't recall another period of time where companies with actual resources, whether that's inferred or measured and indicated, are trading at such a low rate, not $50 or $20 or $70. I mean, I've seen things at $20 an ounce before, but gold was $400.
Right.
Within a relative perspective of 20 or 50 relative to 2000 gold or 1900 on a percentage basis, so percentage of what you're trading at relative to spot price, whether that's silver or gold, I don't ever recall another moment in time where things were so cheap. You know, we at Allegiant, I got calls the last 3 days on our silver part of our portfolio. We have a fairly decent part in silver. We have 8 million ounces at Eastside, but we also have Mogollon, which is in the border between New Mexico and Arizona, which is currently farmed out or optioned out to Suma Silver. I mean, that could host huge amounts of silver there, and I know that they're going to work on it. I was shocked at how many calls I'm fielding on our silver part of our portfolio of our assets. But to get to your question, to answer your question directly, I think there's multiple parts. I think every part of the sector is actually very cheap. Even the seniors are not that expensive. The mid-tier, I would say the juniors are very cheap even on the production side. And then on the exploration side, I once again, exploration, I segment between those who have resources and those who are looking. Very difficult for me to give any opinion on those who don't have a resource, but on those who have a resource, once again, on a relative basis, relative to the price of the metal, whether that's gold or silver or uranium or copper, I haven't seen on a relative basis things this cheap before. And this is going back 25 years at least.
Yeah, you know, I don't focus on the major producers much at all, but I have to tell people that they're some of the best bargains out there and offer some of the best upside out there because they are minting money, as Gwen mentioned, even about copper producers. The margins right now, the profit margins, the earnings right now, at some point, money is money. At some point, the market's going to recognize that with higher valuations. And you know, you want to knock on wood if you ever say something's a can't miss proposition, but it's a great way to bet right now, even the generalists.
Going back to what David talked about, you know, there was 3 billion added of silver in the SLV. That's 20 cents a share. That's if Apple moves between the bid and the offer, that's $3 billion, just to put it in perspective, right? I mean, this market is tiny. The gold market relative to the equity market today is very, very small. I mean, gold is not a small market, but it's tiny compared to, I mean, Apple has a $2 trillion market cap, right? And then you add Amazon, almost 2 trillion. You want to add Google, Facebook, you know, you're at $5 to $8 trillion between 4 or 5 companies. And when I was just looking at my screen prior to this, and if Apple moves between the bid and the offer, so it goes from bid to offer, that's $3 billion right there, just between the bid and offer spread. So, I mean, silver is a tiny market. I always get into this discussion. Silver is tiny. It can move from $25 an ounce to $50 an ounce, and it would be, you know, in a heartbeat.
Yeah.
There really not been any money from, I believe, from the institutional side coming in compared to what I used to see in resource funds when I used to manage in 2007. There were multiple billion-dollar funds. Today, I don't know of any. So, and
and there's two important aspects, I think, to this junior mining market. It is tiny, and as our friend Doug Casey famously said, once the generalists, once the big investors start moving into this market, it's going to be like trying to force the contents of the Hoover Dam through a garden hose. And that's going to, you know, it's going to explode given that much capital coming into it, and it has that much further to move. The other interesting aspect about the junior mining market, and this is what I tell newbies to the sector, is that it's a very inefficient market. If you spend some time and money and skull sweat looking at the market, if you spend the money to subscribe to some of the better newsletters out there, if you spend some money going to the conferences out there, then you can find bargains, you can find deals that are overlooked by the sector. And you know, that goes to junior producers like Avino, it goes to value plays like Allegiant that have big gold resources and are undervalued relative to those resources. It goes also to special situation companies, exploration companies, that it's hard to say that there's a value play in an exploration company. But if you look like a company, Rick, like Barksdale, that is definitely a special situation when you have one of the largest copper projects in sold in recent history, and it extends onto your property right now. That's the kind of special situation that investors look for. What's your view in specifically for your company, but also in general for these, how we can find these kinds of situations that are overlooked by the broader market within that junior mining sector?
Sure. Yeah, Brian, I think it all comes down to the people at the end of the day. You know, if you look back 10, 20 years ago, gold companies traded at big premiums because there was this thought that there was a kind of embedded option value that the management team brought to the table, right? They were going to be able to conjure up some sort of strategy to add value long term. And I think in any part of the cycle in the mining industry, having good management and the right people around that can go out, search for, identify, and acquire, you know, good properties with great potential and the optionality that's embedded to realize that value. That's the most critical piece, right? Anyone can have a nice asset, but it's not everyone that can unlock the value from that asset. There are plenty of companies that were around in the last cycle and had even, you know, higher market caps and share prices back then than they do now because they didn't execute. And so I think the key thing is to find the teams that can really unlock the value in these assets. And you know, Peter with what he's doing down at Allegiant, and I'm sure David, what he's got at Avino, you know, they're looking to unlock the value of these assets, just not sit on their hands and kind of have the day-to-day go by, so to speak. And that's what I really look for when I invest in the mining industry. And that's what I think my shareholders ultimately are looking for when they invest in Barksdale, the company that I run.
Yeah, you know, that's a common theme that, you know, everybody talks about is management, and you want to be with the serially successful people, the people who do it right, because even a really good deposit can, it may not be totally laid to waste by a bad management team, but it doesn't mean that the shareholders are going to make any money in it. In your view, what are some of the not just the good things that investors need to look for in junior mining companies? What are some of the potential pitfalls or red flags that they need to look for when evaluating a potential investment?
Well, from my standpoint, you've got to watch out for chasers. So there's certain management teams out there that they chase any trend. You saw it a couple of years ago when cobalt started catching a bid. Suddenly, everyone became a cobalt exploration company. You've seen it with graphite. You've seen it with diamonds. They're the chasers that are out there, and they're really looking to mine the market more so than they're looking to actually unlock value and create something, right? Create a real business. So that's the number one red flag that I have is just, you know, be cautious of management, what their incentives are and what their motivations are. And then the other thing, or look at the assets and think to yourself, who would want this, right? Where are they located? What type of project do they have? What type of larger companies are actually in search of projects like this? You know, who would have a demand to buy this asset? Because if there's no suitor, so to speak, then the ability to increase your value and execute on you know, a crystallization event for that value is much harder. So you know, if you've got the biggest gold deposit in Antarctica, you know, does it really matter? You know, if you had a modest gold deposit in a place like Nevada, that would matter a whole lot more. So it's not necessarily all about the asset. It's about the management team and what they can do with that asset.
Good point. That's one of the things I've always stressed to people who are new to the area is the size of the prize. There's no reason to invest in a company if they're not going after something that's really significant, at least in relation to their size. And that brings up, Gwen, something I know you always counsel your readers on is share structure, because it's actually possible for a company to go from a $10 million market cap to a $200 million market cap, and the investors never make a cent along the way. And it's when you issue shares, how you issue shares, how many, et cetera, et cetera. How do investors avoid that kind of a trap?
I mean, I think this, when we were in the conversation you just had, I mean, talking about people being the most important thing. The people who run the company are absolutely the most important thing, because they structure everything within. So they choose the projects, they choose the jurisdiction, and they are the ones who guide the capital markets side of it. And so that's, how do you find the money? When do you find the money? What price is the money at? And then how do you manage those shares when they come back into the market? And that is a really important side of especially the junior companies in our space. The smaller the company, the more important these things are. It can be hard to raise money. It's always a balancing act. Sometimes it's your share price is low. So is it a good time to raise money? But if you don't raise money, then you can't do anything. What it comes back to, sort of the overarching takeaway here, is that each management team, the most important thing is that they need to have a plan to create value. So the capital raise has to be to do something specific that has a reasonably good chance of adding value to the story. There's no guarantees if you're in an explorer. There's no guarantees in discovery, but there has to be a plan for how you're adding value and a backup plan. So if that path doesn't work, what's the other path? This is not a science experiment. So, the rocks are finding gold or copper or lithium, whatever it is you're looking for in the rocks. That's science for sure. But running a public company is not a science experiment. It is a effort to create value for your shareholders. So the management team has to have that. That has to be the lens through which they view their project. They have to think of it as, how are they going to create value? What timeline is that going to happen on? How is the capital raising going to fit into that? And then they have to have the ability to manage the effects that capital raising has on a share price. I mean, a free trade date is the obvious example. You raise money, 4 months later, all of the stock that you issued in that financing comes free to trade. That can be a real impediment on a share price. If it has gained in that 4-month period, it can get pulled right back down to the financing price. And so that's one example of how there's so many forces that push junior company share prices around. We wish it were just about the rocks, but it's not just about the rocks. It's about all these other forces that push junior company share prices around, from seasonality of their project to capital raising, to the need to raise capital, to some permitting issue, to a neighbor next, the project next door hitting or missing or doing something that impacts, perception of the area. It's a really complicated mix. So I think if you don't like the complexity of that, the cool thing is that you don't have to take it on. We were talking before about, Peter was talking about how there's been so little big money come into the space. I think we're going to see more big money come into the space, and they're going to come into the space because gold miners and copper miners and silver miners are printing money and they're giving it away. Like, the biggest gold miners out there have structured plans for how much of their free cash flow they are going to pay out as dividends. They're already offering a 2% dividend yield that's well above the 1.6% yield of the S&P 500. That gap will continue to rise because miners are making money much more comfortably than, to paint in broad strokes, a lot of other companies out there. And so money comes from money, and right, they're giving away a strong dividend yield. So I really do think we are going to see money come into the space, and that means that the big companies are also going to move a lot. So if you don't want to deal with all the complexity of understanding the rocks and the financing and all of the factors that push a junior company share price around, you can go for the big ones instead, or some mixture thereof in your portfolio, and it should all work in this market. I don't even remember what you asked me, but that was my answer.
Hey, you were on a roll. I wasn't going to stop you. It was beautiful to witness. No, great points. And, when people say, well, what should I do? Should I go into junior explorers? Should I go into prospect generators? Should I go this? And they hate it when you give them the answer. It depends, and it really does. It's so complicated. It varies from company to company, project to project. Peter, I know you have some strong views and pet peeves in this area. given your history is running a fund in junior mining and as an investor. And one of the things that I'd like to get your views on is it's such a big trend now in the junior mining sector to have prospect generators that don't go through the heavy lifting of exploring a project. And that goes back to structure because they don't have to issue a lot of shares to raise a lot of money to do work on all of their projects. The idea is they do a minimal amount of work, farm it out to a bigger major company, a larger company that then spends the money, and they save dilution, therefore, in their share structure to explore those. And they retain 20 to 30%, typically 30% interest. There are a lot of companies out there and analysts who look at prospect generation as more of a religion than a business model. And my view has always been that it depends. Again, it depends if you have a really nice project, that's worth a lot of value, and you have other projects that you can farm out. You seem to be taking that latter view, kind of a hybrid view of Allegiant. What are your views on how that works best in a junior company?
Well, I'm not a huge fan of just giving away everything. I think that Allegiant has has a little different position where it has a flagship project, and so everything else, the other 9 projects we have, although we view as important and attractive, as a junior exploration, we need to focus. It goes back to what Gwen and also Rick were talking about, which I agree. I've never been on a panel where I've actually agreed wholeheartedly with the other 2 or 3 panelists.
I pick my panels well.
Well, I was going to say exactly what Gwen said. The key thing is communication. It's, she calls it the plan and telling it. I think it's about communicating your plan so everyone understands what's the strategy, what's your business plan, and then you execute it. And you go through all of the noise in cycles and markets, but you try to be as consistent as possible to execute your business plan. You set out the plan and you execute that plan. Clearly, things change in life. Now, going back to the hybrid model and the prospect generating, well, we kind of fell into that business because if we didn't have a flagship project with 1 million ounces of gold, then we would focus on farming out all of our projects and see which one kind of works. But for us, it was a natural transition into that type of business model because one is we have this very large project that's growing in a great jurisdiction. And the other 9 projects we have are completely, are very attractive and could, a single company could build a company around any of our other projects. So for us, it was very natural. We're able to keep our G&A covered through our farm out and our option agreements. We don't have to issue shares. We've been able to maintain a very low share count and keep it very tight. And my red flags as an investor were similar to Rick's and similar to Gwen's, which is the business plan, the communication. I agree wholeheartedly. I was laughing when Rick was talking about the chasers. And I just saw it on Monday, the chasers, where a project I would know about and I knew about very well, which was clearly a gold project with some silver credits, started changing it from gold, silver to silver, gold. And I was just chuckling and I'm like, God, just add cannabis and we're all, we've covered all the sectors, right? It is a pet peeve of mine. I really just, I don't think anyone in our sector, real companies really benefit by that type, but it is the good with the bad. And Allegiant, once again, to answer your question, we are a special one because we do have a flagship project. So it was a very natural transition to farm out the other projects. And some of them are amazing projects. We work with Rick at Barksdale, so he's one of our partners. And so I've known Rick for a few years back in one of our projects in Arizona. So I'm very excited. They've done an amazing job. And all of our partners actually have done an amazing job to advance the project, keeps dilution low. We get cash to pay our overhead, and we get those projects worked on and advanced to a stage that we probably couldn't do ourselves.
Yeah, and of course you are advancing your key project at Eastside, and some of your other projects, speaking to their quality, are actually the keystone projects for other companies. Not necessarily Barksdale, but it's among their portfolio. But there are some really high-profile companies out there that have projects in growth, like Bolo, for example. David, back to you. Avino has a really strange and kind of weird business model for the junior sector, in that you're actually digging ore out of the ground and selling it for money.
Yes.
That's relatively unheard of in the sector. And you've only been doing it for about 50 years or so. So I guess you're still kind of learning the ropes with that project. But how do you, Peter brought up something about the cyclicality of the mining sector in the markets. And that has a different aspect, different meaning for the exploration and development companies that are in the heat of the moment, in the heat of a market, are going to take whatever money they can while they can, and be able to therefore hopefully advance their projects and during a downturn and pick up other projects. What does Avino do? Because you've still got a lot of ore on your property that is yet to be discovered, but you're making money all the time. Are you trying to lock in these offtake agreements, or are you trying and use that money? Or are you trying to retain that exposure to silver prices?
We don't do any hedging. But the key to this whole discussion, I think, when they're talking about management, is G&A. What are people spending? Can they afford to keep up what they're doing? Our G&A, our cost per ounce is all in sustaining is $16. $1.25 is G&A. So we have a lean operation, and we've been able to keep our costs down. $16 is higher than usual because of the grade, but we're exploring, looking for higher grade, and we hope to bring that number down.
Now, another key factor, and Gwen mentioned this, and one that I think is going to be important, increasingly important, because all these big miners are making money hand over fist. And so we haven't really seen the M&A activity that we've been expecting. We've seen a bit here and there, but not really what we've been expecting. It seems to me that, you've got a great story in increasing your production profile in a period of rising prices for silver and gold. But have you heard anything from the big majors? Or do you think that at some point Avino would be a potential takeout target by the majors? Because typically we look at the explorers who have a project and they're trying to get noticed by the majors, either JV or a takeout if they have a resource. You have a producing mine. And I'm asking this because I've never really looked at Avino as a potential takeout target, but it seems to make sense to me as we're talking.
Absolutely. I mean, as metal prices remain strong, these larger companies need to grow to satisfy the appetite of their shareholders. So how are they going to do it if they can't do it organically? They got to look to the producers to gobble up. So I think it's coming.
Even
more
for
M&A.
Even for a small producer and
well, yeah, in the silver space, yeah, for sure. You got the larger producers and they got large market caps. How do they maintain it, let alone grow? So I think it's coming. And we just published a new resource estimate. So that's certainly going to open people's eyes at these companies, because we've got 25 years of production and lots of growth. So there's a lot of leverage there. I think that we're one of the best levered companies to silver, and that's why we traded so many shares on Monday. I mean, because we can monetize our product faster than junior explorers. I mean, we can sell it and keep dilution of shares down.
And after 25 years of production, your challenge is to convince the market that you have a lot of ore left. And I know that you've done a good job of that, because from what I've seen, you have tremendous exploration projects or targets still available.
That new resource basically gave us an ounce per share. So there's your call on silver right now. We're trading at $1.80 Canadian. So we have an ounce per share. So wow. If you look back at 2000, when Bob Quartermain and Ross Beatty started their companies, that's where they were talking. And a silver standard was how many ounces per share. And Ross Beatty was how do you monetize it quicker? So we got both. Yeah, so we're in a great position.
Yeah, I remember Jim Blanchard started Silver Standard and would always call up Bob Quartermain and say, Bob, looks like you've got that 1 billion ounces now. And Bob would say, no, Jim, not quite. Not quite yet, but eventually they did. Rick, talking about M&A, this has got to be right in your wheelhouse, or actually right next door. There's a dramatic photograph in your presentations of one of the greatest copper takeouts in recent memory. I mean, I would check the fence line on your property to make sure they haven't stepped over here and there accidentally. It literally not only has development going on to next to your property, right up to the property line, but from what I can see is there's identified mineralization extending underneath your property line. Can you give us kind of an update of your project in relation to the Taylor deposit?
Sure. Yeah. So right next door, like you said, the Taylor deposit is kind of in the early stages of development. So there are 2 declines going underground to get access to the ore so there can be infill drilled and metallurgical samples can be taken. But there's already a tailings facility, a water treatment plant. There's a lot of infrastructure going in next door. And what we like to say is that we're sitting in the shadow of the head frame that's being built, so to speak. Hundreds of millions of dollars are being put into the property next door. And what we're looking to do is basically figure out how much of that deposit is on our side of the fence. When most junior exploration companies talk about their potential, it's a long-lived potential, right? If you find something, you then have to start down this path of de-risking it, figuring it out from an engineering perspective. You've got to finance it, then you've got to permit it, and you got to put it into production. That's a runway that can go 10, 20 years in some cases. Where we are sitting, if we find something that's important, we're effectively right next door to a mine that's being put into production. So with a change of property owners, you can have a change in the actual classification of the project from early stage exploration to something that's in a mine plan. And so those are the types of shortcuts, if you can call it, that I look for in projects. And that's what we have at Sunnyside, our main flagship project. And that's what we're looking to kind of de-risk. And that's where we think the value for our shareholders is going to come from at the end of the day.
But it's also important to keep news flow to the market, and that kind of a news flow with that developing project next door isn't really in your control necessarily, but you're also delivering, I mean, you have a property, it's hard for people tend to overlook the rest of your property portfolio, having a lot of catalysts coming up in that regard as well, aren't you?
Yeah, exactly. And so the projects that we have in Arizona in this district that you talk about that had the prolific M&A event, we've been building that slowly over the past couple of years, and we're permitting our project for exploration drilling, which takes quite a bit of time in that part of the world. And so we've been patiently and methodically moving these things forward, which, as you can expect, is not exactly the most sizzling market news when you're giving permitting updates from time to time. Like people just they fall asleep and they land on the sell button. They just don't care. And that's why it's important to have a core group of investors that believe in the strategy and they're there for the long term. We have a significant amount of our shares locked up within a handful of names that I know exactly where they sit with respect to our long-term value proposition. And I know that they're not sellers, and that's what it takes. So when our stock falls too low, we all buy it up, and including myself. I've bought all my shares on market over the past couple of years. And so we view those as opportunities. If the short-term impatient people can't stand the ride, so to speak, then that's fine. The long-term investors that are looking for that large exit at the end of the day instead of the small incremental gains on an intraday basis, that's where we take over. And so we have this long-seated project up in Arizona, but we've new shiny down in Maxwell that we think could be the kind of the start of a new district. Our largest shareholder, Cisco Development Corp, is another kind of anchor landholder in that same district. And we've got an existing copper resource down there that we're kind of unraveling right now. And as soon as we figure it out, we'll start drilling it and start expanding it to take it from a couple 100 million tons to hopefully something, a couple 100 million pounds of copper to something much larger. So as Gwen alluded to earlier, plans are important because, as an old mentor used to say to me, a goal without a plan is called a dream. And so you just got to make sure that you're founded in reality and you've got a good plan that all of your shareholders, or at least the core ones, believe in.
Peter, Rick brings up a good point, and basically it's eating your own cooking. refreshing to see three mining executives, junior mining executives here who do habitually eat their own cooking and and have their own blood on the table, as it were. So I know that you do, Peter. I know that you buy your company's stock. But what's interesting to me, and again, this is one of those things I'm just kind of considering as we're talking. Allegiant is a premier M&A takeover target, I would think, given your resource, given your location in Nevada. It would seem to me to be a premier M&A target. One of the keys for a junior mining company is they want to get in a bidding war over their property. They want more than one major interested. And if you can't get two majors interested, you want the ability to just go ahead and develop it yourself. It seems to me that that's not a big hurdle in Nevada for the kind of project that Allegiant has, and that you will always be the other natural alternative buyer for your project in any kind of an M&A situation.
I mean, I think all of those are fair comments. Our goal and our objective is to create a multi-million ounce deposit at Eastside and try to do that in the least dilutive manner possible. And that henceforth, that brings us to this farm out strategy. We're focused on building multiple multi-million ounce deposit at Eastside. And if people want to come and bid, I mean, we take inquiries all the time, and clearly probably in the center, if you want to come to Nevada and acquire something, I'm sure we're on the list of everyone. But all we can control is execution of our business plan. That's why, going back to what Gwen keeps on saying, so I really am a firm believer. You put it on your presentation. This is what our goals are for this year. This is what our goals are for the intermediate term. And then you can measure us, whether we've succeeded or failed based on measured against that. You just put it on, very transparent. And to your point, to your question, probably we're on the radar screen of a lot of companies to come into Nevada who want to. And I can't really at liberty talk about any of them, but what I can say is that the only thing we can control is execution of our business plan. And our business plan is very simple: build a multi-million ounce deposit at Eastside. And we've laid out a strategy which we believe gets us there. Now we need to execute, and we need to have luck.
Well, speaking of plans, we kind of violated my plans in that we went into the details before the overview. So now I'd like to back up and go to the beginning and start off with Gwen, because she does such a great job of this, and go back and look at the overview. Looking forward, 2021, still early in the year. Gwen, what do you think are going to be the best opportunities for junior mining investors this year? What sectors should they look at, and what trends should they take advantage of?
Big question. I think that the energy metal space is going to continue to be pretty exciting. When I say energy metals, I really focus on like the big ones like copper, silver, nickel. I don't really play in the small spaces. That's not my area of interest. I think copper in the near term, there may be some downside. There's been a huge gain. There's a lot of reasons based on Chinese usage and then Chinese and what to. There may be weakness in copper in the next, believe in the copper narrative, which I do. So I think copper is going to be an interesting space to be in, and I think that it hasn't gotten a huge amount of attention in the mining narrative yet. So I'm excited about that. I am going to go out on a limb and talk about uranium a little bit. We've sort of been waiting for uranium for quite a while, but COVID really poured fuel on what was already sort of a smoldering fire there. We have an absolute deficit of uranium coming. And as we exit COVID-19, and there's all these projections for growth and all the stimulus going into growth, and then we have a Biden administration, and so which supports green energy initiatives, and then we have certainty on a bunch of issues that were hindering the uranium market in the last few years, like disagreements between America and Russia on who is buying what, stockpiles where, and this whole thing about the US and the reserve that they're creating of uranium. A whole bunch of questions that had hung over the space and prevented people from acting have now been answered. And so And now there's, Cigar Lake is suspended again because of COVID infections. Kazatomprom has spoken in every news release they've put out in the past few weeks. They talk about COVID and case counts and their worries. There's a lot of reasons to believe that the COVID impact on uranium supply is going to last for a while. So it really is lighting up something that's been sort of getting set to go for a while. So I think it's a good year to position in uranium. I don't know when it will go, but I really do think it will go. And I think major users, the utilities, are going to have to start signing some long-term contracts for uranium soon. And that's the thing that we've all been waiting for in the uranium space. And then I certainly like gold. I think how you play the gold space depends completely on you as an investor. You can, as I said, you can literally buy Barrick, probably do pretty darn well. Or you can buy, the pre-discovery explorer. It all depends on how engaged you want to be with the story. You got to pay a lot of attention to the pre-discovery explorer. You hardly have to pay any attention at all to Barrick. So how engaged do you want to be with the story, what your level of knowledge is, what your risk tolerance is. But you can build a portfolio anywhere across that risk profile in gold, and I think it will do well this year. So it's really up to you to decide which part of the spectrum you want to play in. But I really think it's going to be a fun game.
I agree, Gwen. And if there's one challenge in this sector, I tend to like everything. I agree with you on uranium. Gold and silver drive everything. Then, the history of these markets is you have gold and silver, then people get interested in copper, then all these other little markets, rare earths look interesting now. There's some news out this week from the Department of Defense. Copper, I'm a big bull on. The energy metals, as you mentioned, you didn't mention lithium. It's hard to find real value there. But it's the dynamics, supply demand dynamics are just so compelling. A lot of different areas. If you get back down to it, though, back to you, David, I tell people if you like gold, and you really should, because the fundamentals are really driving it, you have to love silver, and that seems to me to be a story of not just the moment, but of the future. I would take it that you would agree.
Absolutely.
But do you really? I mean, I know you do, but what's your view on these big picture monetary trends that are driving the metals? And are you fielding? I mean, I know you are most recently, but looking at the generalists, are they really interested in silver? Some of the bigger funds.
Well, I think there's some, yeah, for sure. But we haven't seen the kind of money coming in, like Peter mentioned before, on the trading that goes on, with Apple and the bigger company. We haven't seen that flow yet. We saw a touch of it on Monday, but I think we're going to see more of that. So I'm very bullish. I'm excited about the future of silver and gold and copper as well. I think the helicopter money is going to create, weaknesses in governments and their with their debt going up and their dollars weakening. I think we're going to see metal prices continue to trend higher.
Yeah, I agree. And if people are looking for, I tell our readers, if you're looking for leverage to the gold story, you buy silver. You want to look at leverage to silver, you buy the silver juniors. So you're getting leverage on top of leverage. Peter, what are you looking at? What are your best areas, do you think, because you are an investor, have been an investor in the junior mining space for so many years, what are the sectors you would recommend or areas you'd recommend, and the trends for next year that you feel are going to be the most impactful for investors?
Well, I'm going to answer this question today a little bit different than I would have answered it, say, 6 months ago. I do agree a lot with Gwen, and my fund used to be one of the largest investors in the uranium sector I know fairly well. Today, I'll answer the question a little bit different. I think gold probably, to me, is the most attractive part. And the reason is that all of the shine and the euphoria has kind of come off the last 3 to 4 months. And I think that's healthy. So from a risk to return and valuation perspective, I do think gold today on a risk to return basis is probably the most attractive. I think from an upside basis, I think uranium offers huge upside potential. and the equities are very, very cheap. I remember when I first got invested in uranium in 2004, I think there was one of 10 companies or 15. I may be wrong, 20 maybe. And then in 2009, after we had a very large position in a company called Hathor Exploration, actually we were the largest shareholder for years. There were 300 publicly listed uranium companies. So we're not even close to that. There's a lot of uranium in the world. It's just, there's not a lot of economically viable assets at $30 a pound spot price, or 28 or 29. Probably need to see $50, $60 minimum. Just the producing ones probably need 40. If you're going to put a new asset into production, you probably need $60, $70 a pound. But it's the same dynamic for gold too. And I see that gold, I think gold really, the juniors, and whether that's minor, and then when I say gold, I also mean silver. The precious metals on a risk return basis, in my opinion, continue to be the best purchase. Now, I wouldn't have answered that 6 months ago the same, because there was that mini euphoria that had come in. So it's all based on timing. And today, timing, my opinion, the precious metal sector tends to be, whether that's exploration or mining, tends to be the most attractive part. But yes, if I look at it, not adjusting for risk to return, uranium offers some amazing potential.
Rick, I'd like to give it to you to close this out, and with a comment though that, you know, the next thing would seem to be at the gold and silver, in looking at the way things have played out historically, would be copper. And in Gold Newsletter, we called a new copper bull market, and in fact, a new broad commodities bull market in late July, when we saw the momentum indicators going up for copper. So it's been going on for copper for a while now. What have those copper juniors been discovered by the general market? Because I don't really think they have yet, even though prices have gone up for the underlying metal. I don't think it's filtered down into the juniors. So if that kind of an easy setup for you to promote your own company to some extent, what sectors do you look at for the next year as being most interesting for investors?
Yeah, based on where we're at in the copper cycle, the kind of that, let's call it the first or second inning of that overall cycle, I would say you start positioning yourself in the actual junior explorers. So right now you see the majors, they're sitting on earnings growth. Freeport just raised their dividend today. That is ultimately going to translate as we get deeper into the cycle in production growth. They're going to look to expand their projects, put new ones into production. And then once they kind of maximize their internal production profile over the long term, they're going to start looking, because the cupboards are bare, so to speak, and they're going to start looking for new opportunities to add to their portfolios. And that will bring about an M&A cycle. And so you want to position yourself well advanced of that cycle starting. So I would say get into the junior explorers that are looking for copper in good jurisdictions, because if they have success, you know that the eyes are going to be on them, that the copper majors, especially on projects that can be pushed to production quickly, or they have size and scale, or some sort of a synergy with an existing operation, they're going to be highly coveted.
And that's where some really big money can come into play when you look at the big copper producers. Panel, thank you so much. This has been very entertaining, very valuable. I think we've gone just about an hour. I know we try to keep it to 40 minutes, so this is about typical and par for the course. But great value, great contribution, so I didn't want to cut anybody short. Really appreciate your input today, and it's going to be an interesting year. I hope it's a better year than last year on a lot of ways, but I think it's going to be a very good year for metals and mining, and I really appreciate your input today. Thanks so much.
Thanks for having us, Brian.
Brian.